This is Excel 2016, Module 9, Part 4. We are going to be looking at depreciation of assets. In Excel, you can calculate depreciation in multiple ways. So we're going to be looking at two: straight line and declining balance. So let's take a look back in our workbook. We finished our amortization schedule and our loan analysis. We're going to go back into our startup and we're going to look over here at our assets. So we have this amount of long-term assets. We are going to determine that we need to buy $200,000 worth of long-term assets. Long-term assets could be equipment that we're going to use in our manufacturing process. Could be computers, it could be office furniture, it could be buildings, but it's things that are designed to give us a benefit for multiple years. So now we're going to go over to our depreciation worksheet and we're going to enter some information about our assets. So we are assuming we need three pieces of information for our assets. We need the cost of it. Well, that's on our startup worksheet. So we're going to enter a formula. It's equal. We go back to the startup worksheet and we're going to find that long-term asset account in B13. The next piece of information we need to have is something called a salvage value. So what a salvage value means is if I expect that this piece of equipment or whatever this asset is going to last 10 years. That's how long I'm going to be able to use it for its intended business purpose. Then I need to determine if I can sell it after that 10 years, what is it worth? And so my estimate is that it's going to be worth $50,000 at the end of the 10 years. So $50,000 is your salvage value. What is it worth at the end of the life? And then the life of the asset is how long you expect to be able to use it for its business purpose, which we're going to say is 10. Now what depreciation is it's a way to spread the expense out over the life of the asset. So instead of taking $200,000 of expense on the day I buy it, I'm going to spread that out over the life. Now, I can't depreciate or take all $200,000 as an expense. Excuse me. Because $50,000 of it, I think I can get back at the end of the life if I sell the asset. So I'm only going to take the net of those two numbers. I'm going to take that $150,000 and I'm going to somehow spread that over the life of the asset. It doesn't always have to do with physical deteriorating of the asset. It doesn't mean that just because in 10 years I'm instantly going to stop using it. If I determine after 10 years that it's still serving a good business purpose and I don't need to get rid of it, you just don't get to take any expense anymore. Okay, but you can, a lot of times I have fully depreciated my computers and I still use them for a very long time. And then after it's no longer functional as my primary computer, it might be able to be useful as a scanning station or some other purpose. So it doesn't mean you're just going to automatically get rid of them. It also doesn't mean that you're assuming that this is the reality of how it deteriorates. Okay? It's just an estimated way of spreading that cost. So let's look at the first and the easiest way. This is straight line. So we're going to click in year 1. And we are going to be copying these formulas, so we do have to make sure we pay attention to absolute versus relative referencing. So we're going to go up to our formulas. Again, these are going to be under financial. We're going to look for SLN, which is straight line. Make sure when you're doing your homework that you look for the type of depreciation, not just the word depreciation. Because if you look right below it, that is another form of depreciation called sum of the year's digits. So there's a lot of different options. Make sure you read carefully to get the correct one. So we're going to choose straight line. We need to put the cost. That needs to be absolute. We don't want that to move. We're going to put the salvage value in. Again, that must be absolute. And the life. So that has to be absolute. With straight line depreciation, that's all you need, because what straight line depreciation does, it takes the total amount that you're going to expense, which in this case is the $150,000, divides it by the years, and then it takes an equal amount of depreciation every year. So if I copy these formula out, you can see the depreciation stays the same. Now this next formula, this is cumulative depreciation. We need to keep track of how much total depreciation we have taken on every asset over the life of that asset. If we sell it, then it's going to impact the entries that we need to make. And we also need to make sure that we don't take more depreciation than we should. So what we're going to do, we are going to say it's equal to this year's depreciation. Now this second year, it's going to be equal to the first year's depreciation plus the depreciation in the second year. So every year it's going to look at the year before, add the current year, and put the total there. So if we copy this across, you'll see it keeps accumulating. And then finally the depreciated value. And what this formula is I'm going to start out with the cost of my asset. I'm going to subtract the cumulative depreciation. Now I am going to copy this. And the cumulative depreciation is going to shift, but my total cost, or my original cost, needs to be fixed or absolute. And you should see this amount declining. Now, what should happen at the end of the life, your accumulated depreciation should be $150,000 and your depreciated asset value should be $50,000, which you come down to the salvage value. The reason you can't see that here is because we're only showing the first 5 years. So if I were to change this life to 5 years, you would be able to see that your total cumulative depreciation is the $150,000, the difference between the cost and the salvage value. The depreciated asset value at the end of the life is the salvage value. I'm going to go ahead and change that back to 10. But that would show you, that's kind of a good check and balance. Does this work the way it's supposed to? Now, most of the other depreciation methods choose some way of accelerating depreciation. So one argument for this is that when I first buy the asset, it's efficient, it's working well, it doesn't require a lot of maintenance expense, and so I should have a higher depreciation expense in the beginning. As it gets older and I have to put more money into it to maintain it, then I want my depreciation expense to be lower so that my total expense, maintenance and depreciation, levels out a little bit. So that's kind of one justification for why people do it. Another reason might simply be, if you're looking at taxes, they might do it because they want to accelerate the depreciation and get the tax deduction sooner. So there's a lot of different types of depreciation. Some are used on financial statements. Some are used on tax returns. So one of the other ones that's accelerated is declining balance. So we're going to take a look at that one. So we're going to go to the yearly depreciation. And that's going to be under financial. We're going to choose DB for declining balance. So again, we've got the first 3 fields look the same. We have the cost, which must be absolute. We have the salvage value, which again must be absolute. And we have the life, which also must be absolute. Now this next field says period, and it's what year are we looking at. Now if you're trying to calculate annual depreciation and monthly, we can use that month column as well, but we're not going to be doing monthly, we're only going to be doing year. And you can see what year it is by the number right above. So we're going to use that, and I want it to be relative because I want it to change so that in the next column it's going to look at year 2 and then year 3. And since the depreciation is accelerated in the beginning and gets lower toward the end, I need to know which year I'm in order to calculate it. So I'm going to go ahead and click OK. I'm going to copy these 2 rows of formulas. I'm going to go back to my Home tab and choose Copy. And then I'm going to come down here and, oops, it didn't want to do it. Let's try it again. Copy. There we go. Come down here and click Paste. Then let's go ahead and drag this across. So as you can see, the yearly depreciation started higher and got lower. Now, so that you can see this even better, let's switch this to a 5-year life just for a minute. And notice the beginning depreciation here started out higher, and at some point in the middle, it drops below the straight line. They both do very close to the same total depreciation, and they both bring you very close to the salvage value at the end of the life. So it's just two ways of getting at the same answer in the long run. We're going to do 10 for our life and put that back. And now we have the depreciation information that we'll need on our income statement. Depreciation is an expense. It's going to show up on our income statement, and it's going to reduce our net income as a company. So the next segment of our videos, we're going to be taking a look at actually creating that income statement now.